All right, Steve, let's turn to you because it's not just the equity markets right now that are seeing some of these elevated levels. A lot of folks in our audience right now, listeners and viewers and readers alike, understand that gold prices have been kind of, I wouldn't say surging, but they slowly and steadily have been moving to the upside. We've crossed the $4,000 per troy ounce mark now. It seems like there's just no end in sight for the move that we've seen higher in gold prices. I wonder if you might take us through just how you are viewing some of those elevated levels in the yellow metal compared to the kind of price action that we're seeing in certain parts of the broader equity markets. Are they alike? Are they not alike? And if so, what are the similarities and differences between that gold trade and what we're seeing with the S&P 500?
Yeah, absolutely. So gold's always traditionally been viewed as a safe haven for economic turmoil, geopolitical instability, things that we're seeing right now because it doesn't have a yield. Generally, falling interest rates are beneficial toward gold. That's when we see a lot of investors start to move into gold. So far this year, we've seen on physical gold exchange-traded products about $38 billion of investor flows going in. What's really happening now is a shift into the acceptance of gold. Typically, it's been viewed as kind of a fringe or outside metal and allocation tool. What we're really starting to see is now more prominent economists are starting to shift or suggest shifting from a 60-40 model to something closer to a 60-20-20, where it's 60% equities, 20% fixed income, 20% gold. Most people, we feel, are probably well positioned if they have about a 5 to 15% allocation of physical gold, depending on their risk tolerance. What you get out of gold is that hedging to the broader investor universe. So when you start thinking about things of correlations, well, how well does gold move versus other aspects of the economy? We tend to see low to moderate correlations across most major asset classes and an inverse correlation to the U.S. dollar, all aspects of the economy that investors are starting to feel uneasy about at the moment.
Does that make you feel as though, Steve, does that make you feel as though there is going to be a continued bid for gold, given the fact that at least for the medium to longer term trend that we've seen so far, there is a decline in the value of the U.S. dollar relative to other developed market currencies? We are continuing to see some geopolitical risk. The Middle East peace progress aside that we've seen, there are aspects of, say, a government shutdown that we are currently still in, political risks in the U.S., geopolitical outside, the dollar and everything else. Does that mean gold does have a clear path forward to the upside or not?
We do think there's still significant room for gold to run. I think today's a great view on that. We see the deal in the Middle East that hopefully can relay tensions down a little bit. Gold's higher this morning, over $4,100 an ounce as we're sitting here. We're seeing, discussions about potential reciprocal tariffs and, as it relates to rare earth export restrictions coming out of China and what that might do to elevate an already tenuous geopolitical realm that we have with China. That's pushing gold prices higher. I don't think those overlaying macro factors are going away anytime soon, and I think that's something that investors are really latching onto. Another aspect I think that's really important to gold is that a lot of central bank buying is happening in the metal. So that's really pushing prices higher. Over the last 3 years, it's been about 1,000 tons per year. We're still seeing continued buying from central banks. What that does is allow central banks to de-dollarize their assets. They can move out of treasuries, move into gold, and at the same time, they can actually repatriate that gold back to their home countries for their own self-storage. It gets it out of the way of sanctions that could potentially come from the United States or other countries.
With regard to just how you view what's happening with the relative exposure in certain people's portfolios, you had said maybe a 5 to 15% kind of allocation that some people maybe already have. You talked about the evolution of a 60-40 to a 60-20-20 in terms of bonds and alts on that 2020 side of things. If that's the case, what exactly does that mean for the total addressable market, if you will, for investors out there in terms of how much more they could put into, say, a gold or a silver trade because they don't have as much exposure as they may want? And how exactly would investment advisors start to get their arms around that kind of paradigm shift towards being more exposed than they have been in the past to things like gold and silver?
Yeah, there's several ways to get access to gold and silver for that matter. Typically what we see is that investors tend to be underallocated to gold, below that 5% allocation that we typically see from investors that have a significant portion in their portfolio. As it relates to gold and silver, there are other options where you can kind of get some outsized returns by investing directly in the mining equities. So gold miners, silver miners, they have operational leverage to the underlying price of gold or silver, which typically allows them to outperform over longer periods of time in bull markets. We're coming on to a period now where if you look at the top performing ETFs in the US, 12 out of the 13 best performers are gold and silver miners. So they're far exceeding what we're seeing from the physical metals themselves. That does go back to that operational leverage, but at the same time, as it relates to gold miners, we're not seeing significant investor movement into gold miners, even though they're returning 120, 130% so far this year, which is about double of what we're seeing from physical gold. So we do think that there's opportunity through gold investment, either through physical or through the miners. That really comes down to investor preference. Once you start moving down the route of miners, you start to introduce equity investment risk. Some might not be comfortable with that. Usually what we say is that physical gold is a good stepping stone into the gold market. Investors can understand kind of how the metal works, how it fits within their well-diversified portfolio, and from there we tend to see them branch out into
Steve, that's an
other
interesting
aspects.
point now. So if you take a look at it from, say, a retail investor standpoint, or maybe even an investment advisor standpoint, do you treat the gold mining, silver mining type stocks and gold in the same way in terms of allocation? In other words, if you hypothetically had that 20% allocation to alts and metals specifically, say gold, do you then mix that between the gold miners and the gold metal itself? And is that part of the allocation, or do you have to kind of segment out gold miners and have them be more of an equity type component as opposed to an alternatives component in that allocation?
Yeah, it's a great question. So typically we look at gold as that, that ballast within the portfolio. So it's there over market cycles. You may adjust it up and down somewhat, but we advocate for a long-term position to gold. Where we tend to see the miners come into play is through investors that they're looking to take on that equity risk, and they can dial up or dial down that standard gold exposure that they have in their portfolio. It does open up a lot of operational complexities that we see in mining, so there are additional risks that you might not see in other sectors. And so because of that, it's more of a way to move the lever around their strategic allocation to gold.
Steve, as we talk about what's happening with the commodities-based allocations or components, there's a case to be made that the elevated levels that we are seeing here should be a note of caution for those people who are looking to, say, get more exposure to those metals. Within that metals complex, we mentioned gold prominently. I had mentioned and alluded to silver before. From a kind of ETF strategy standpoint and an allocation standpoint, just how would you carve up that kind of metals allocation? Is there one where it's equal parts gold, silver? Do you tilt more towards gold then silver? Are there other maybe platinum group metals that you think are going to be part of that exposure? How do you treat the allocation within commodities and those alternative sides of assets?
Yeah, I would say gold tends to be the most common, right, because it is a purely precious metal. And we do see that being used not only by investors, advisors, and institutions, central banks. Silver's a little bit different because it is a dual metal. It's part precious metals, part industrial metal. And actually, the industrial metal component is about 60% of overall demand now for silver. The intriguing thing about silver is while you can get some of those same diversification benefits, the low to moderate correlation to major asset classes that we see with gold, you also get the growth component that you can see coming through industrialization, the energy transition, automation, and electrification, artificial intelligence. Silver is very vast in its uses, over 10,000 uses, and as the most conductible metal on Earth, as we're trying to electrify, it's becoming more and more important. What we're seeing out of investing in silver miners is drastically different than what we're seeing out of gold miners at the moment. Flows have been coming into silver miners for most of the year, whereas gold miners, the flows have been outflows, surprisingly. So what we're seeing is investors are able to take that gold as their precious metals allocation. Some do like the additional torque that you tend to get out of silver relative to gold. It does tend to outperform in rising markets, which is where we find ourselves today. But then if you're looking at the miners, the silver miners can fall right into a growth sleeve, into a commodity sleeve. So it can really help enhance some returns around while still providing that precious metals exposure.
What exactly could happen for us to see market downside for gold, silver, and other kind of precious metals in that trade?
Yeah, so for gold, what it would take is to see some of that risk coming off the table, geopolitical, economic risks. I would think that in the near term, that seems quite unlikely. If you're looking at silver, a little bit different with that industrial component. If you start to see slowdowns in AI investments or slowdown in global economy, you could see some pullback into silver prices. But in our view, silver has actually been under invested in for so long that we think there's still considerable room to run for silver. The main difference that we see between the two metals, gold has central bank buying associated with it. Silver doesn't have that underlying demand. So expect a little more volatility with silver, even to the upside. But that's one of the things I think that could potentially, cause a pause, I think, in upward movements.